And let me officially welcome you to Charting a New Course, our brand new workshop, Preparing for an Unemployment Transition. It is my pleasure to introduce Michael Pampanelli, who is a Vice President with AXA Advisors in the Philadelphia area. Michael works with individuals, helping them define and achieve their retirement, their investment, and estate preservation goals. He has a specific interest in assisting clients in career transition, guiding them from a needs assessment to determine their individual goals to building a customized plan. He is a board member of the National Association of Insurance and Financial Advisors of Greater Philadelphia, a member of the Society of Financial Service Professionals, and the Philadelphia Chapter Chair of Chem Pharma. His FINRA registrations include Series 7, 66, and 24. So needless to say, Michael is a very accomplished person in the field of financial advisement. So with that, I'm turning the microphone over to you, Michael, and take it away.
Thank you, Barbara. Appreciate the introduction, and welcome everyone to Charting a New Course. And today we really want to focus on financial concerns for people who are going through career transition, but the topic is relevant to anyone going through any type of financial transition. So with that, why don't we get started, and do feel free to either raise your hand to ask a question or enter something in the chat box as we go along. Yeah, let me just advance the slide here. Okay, just one important disclaimer. Please do be advised that this presentation is not intended as tax or legal advice. Accordingly, any tax information provided is not intended or written to be used and cannot be used by any taxpayer for the purpose of avoiding penalties that may be imposed on the taxpayer. The tax information was written to support the promotion or marketing of the transactions or matters addressed, and you should seek advice based on your particular circumstances from an independent tax advisor. Okay, so that is important. We will be discussing tax implications of things, and this will be really at the federal tax level, as we're all in different states and each state has their own particular laws. You know, Harrison Ford once said, we all have big changes in our lives that are more or less a second chance, and we're happy to be part of this change in your life because it does give you a second chance. And I think as you go through the career and financial transition, you will find that there are many opportunities that will present itself that you may not have otherwise discovered. A couple of objectives that we have for today. One, we really want to focus a little bit on some severance payout options, so anyone who's on a severance package, some things to be aware. We'll also take a look at some risk management considerations such as cash flow, health insurance, life insurance, and also provide some alternatives to address concerns here. And then we'll talk about distribution options for retirement plans as well as other retirement planning considerations. And if anyone has stock or stock options in their company, we could spend a few minutes addressing those concerns too. And we'll introduce a concept called pension maximization, which is how do you get the most out of your pension. So let's start off with a couple of the objectives, but first, please, and if anyone, let me know if there's anyone out there by show of hands or chat box, if there's a topic that we did not, that it didn't sound like we were going to cover, and if we have time, we'll try to address that at the end of the session. Okay? Couple of things as we look to talk about some of the transition concerns. One of the big concerns is the area of cash flow and loans and debt handling, so we'll spend some time on that and then really get into some of the other options that you have going forward. So let's talk a little bit. We call this risk management because cash flow is about risk management. And just a general question for everyone: has anyone began some type of financial planning process? I'll just wait a second, see if anyone puts their hand up on that. Okay, so Arthur, you've started. Beth, so everyone has done some level of financial planning, which is great. You know, hopefully one of the benefits you find going through any of the financial planning processes is it's an opportunity to educate yourself as to some new ideas, concepts, and tools that you may not be aware exist. So, you know, I look forward to sharing with you some information. But also, if you have something that we miss and you want to share it with the group from your experience, please feel free to, again, raise your hand, and we'll try to get your comments and thoughts entered into the discussion. So let's talk about cash flow. And when we talk about cash flow, a lot of times people think in terms of having a detailed personal budget. I'm not sure that's always necessary. I think that there are some other ways, simpler ways to go through this. One, has anyone prepared a personal budget? I'm curious, again, by show of hands, if anyone has actually sat down and prepared a household budget. So, Beth, I'm not sure if that's a yes or a no. Okay. So, you know, and again, I'm not a huge advocate of having detailed budgets for the household, but I do think it's important to know where the money's going. And there are probably some easy ideas out there where you could save money, a substantial amount of money, without really a lot of effort. So I'm going to throw out a couple ideas, and certainly if you have your own ideas, I'd love to hear them from you as well. One, I think it's important to know from a big sense where the money goes. So is the bulk of your money going to service debt, pay off mortgages, student loans, etc., car loans, or is it vacations, trips? So having an idea of where your cash is going is important. And you know, certainly once in a while taking a look at your checkbook or credit card statements and going through that to see where you're spending is a great idea. However, there are a couple of big places that we could look to save money. One is home entertainment, data, phone plans, computers, that type of thing. You know, in this area we have probably two big vendors of data services, Verizon and Comcast, who deliver content to our homes in and around the Philadelphia area. And the easiest thing to do is to, if you're on one service, just go to the other service provider and see what's available. A lot of times you could save substantial money and not give up really anything just by shopping the services that you do have. One other thought is when you contact your current provider, you know, ask to speak to someone in the conservation area. So what that is, all these companies want to keep clients. They don't want to lose clients. So if you, when you call in and try to see what plans they have available, you know, the service department, the 800 number, will only give you the plans that are listed. But if you get to the conservation area, they will give you some other ideas about plans that could be very helpful. Okay, I have something here from Diane. I suggest immediately, if you had a severance with Cobra, Check, and other health insurance companies.
Yes.
Yeah, Diane, we fully agree. That is a big one that we're going to talk about on the next slide. Cobra could be a very, very expensive option. basically it's the full cost of your insurance plus about 2% administrative fee. And a lot of times you could go to other options that would be much more cost effective. Also, one thing to note is that when you're shopping for insurance, and today we have the exchange and a lot of the laws have changed, but in many states it doesn't cost you any more to go through a broker than it does to try to shop for yourself. So it is a confusing and very changing landscape out there. And contacting a good health insurance broker that you trust doesn't cost anything, and it will help guide you through all the various plans and options that you have available and help get you into the plan that's right for you and your family. Yeah, so Diana, so you say it took you about 7 months to figure that out. That's pretty typical. It is a pretty intense thing to go through and try to sort out all the different plan options that are available. While we're on the subject of that, you know, the other thing to always look at with health insurance are your spouse's plan. So a lot of times your spouse may have a plan that might be cost effective. Sometimes that may or may not be so. The other idea is from a budget standpoint, personal insurance, property casualty insurance, your homeowners, your car, auto, maybe you have an umbrella policy. Well, if you haven't reviewed that in a while with your insurance broker, it really does pay to sit down. A lot of times they will not be proactive in coming to you with ideas, and what you find is that just by redoing the current plan, you could save substantial money without ever changing carriers. But you have to ask, and I think that's the key to all this stuff. Is it's kind of up to us to ask. And if you get out there, you know, certainly if you go out and get competitive bids on your homeowners or auto insurance and go back to your carrier if you're happy with the service, they will probably come up with something that's competitive. I know I did this for myself a few years ago, and I saved you know, close to $1,200 for the year, and basically kept the same carrier and actually improved my coverages a little bit. So definitely a big thing there. Another idea is memberships. So maybe you belong to health clubs or professional organizations. You know, it may not be the time to not go to those things or drop out, because you know, when you're going through career transition, those things are important. And what you'll find is if you go explain your situation to the membership, the club, whatever it is, a lot of times they'll have special deals for people who are going through a career transition, and they'll offer you reduced rates for a period of time. So that is also a really good idea, and one that's very easy to implement. We've heard other things from people. I think the key is to ask. So wherever you're paying for a service, just ask if they could do better on the price, and you'll be pretty surprised. So there are some simple ways to save money without really changing your lifestyle. I think that's the important thing here. Any other thoughts on the budget? Does anyone else have an idea that they'd like to share with the group? Okay. Let's talk a bit about, a little bit more about COBRA and what that is. So when you're on severance, you're generally covered by your group coverage. When that ends, you'll get notification that you'll be able to go into the COBRA program, and COBRA is basically an extension of your group plan without having to go through any type of application process or underwriting process. They will give you coverage for 18 months. You usually have 60 days to enroll. However, it can be very expensive. So definitely before your COBRA is due, or before your time period on your current benefits are due, really investigate your other options. It's important that you do look around and see what your options are. Your spouse may have a plan, but that may not be the least expensive option. There are many times where the spouse's plan looks very cost effective, but when you add the family in, the costs are extremely high. I see that someone, it looks like Diane said, also watch out for brokers or underwriters that are sketchy. You really need to get to someone that you trust. I think that's true for any advice. Referrals are always important. Get to someone that that you know has a good reputation through word of mouth. Yeah, okay, Diane, I see. Your benefit was still available, but yeah, you do want to check out your health insurance options sooner rather than later. It does take a while. It could take up to a month to get a new insurance plan in place. With today, with the new laws, you really can't be without insurance and you can't be denied. However, there are still surcharges and upcharges for pre-existing conditions and other things. So, do your shopping early, have a plan in place, and it will pay for itself. One of the other items that we lose during when we lose our jobs is life insurance. And many of us take our life insurance through our employer. When we lose our life insurance, sometimes we don't know what our options are here, and sometimes our companies may even offer us a group buyout or an offer to extend the group. But a couple of things to be aware of with life insurance. One, there are several different types of life insurance. Three basic types are term, which provides coverage for a limited time period, usually with guaranteed rate, very inexpensive relative to other types of insurance, and it's great for covering off events such as, hey, I need to get to retirement, I need to pay off my mortgage, I need to get my kids through college. The downside of life insurance, term life, is that it doesn't extend beyond the term of the insurance, and that's typically 10 years or 15 years or 20 years. The other types are permanent, and we say permanent in that they will be there for your entire life if you fund them properly. And they break down into two basic types. One is whole life insurance. Whole life is a permanent insurance with a guaranteed level premium, and cash value grows in it. Why is cash value important in life insurance contracts? For a couple of reasons. One, it grows tax deferred, and when you take it out, you can take it out tax free. So that sounds like a Roth IRA, and in many respects it can be an alternative savings vehicle. But another really important feature of having cash in your life insurance contract is that it gives you future options. So cash is always good to have, and cash in a life insurance contract gives you future options. So when you take out a permanent policy, what you're buying is future options. In other words, maybe in 10 years or 20 years, that policy is not appropriate for you anymore, but you could use the cash in that to exchange it for an insurance contract that is more appropriate. So whole life grows its cash with dividends and interest. You're in the general account of the insurance company, so you're basically a creditor to the insurance company. Universal Life is a permanent product that offers a lot more flexibility than whole life. In general, the premiums in universal life products are going to be less than a comparable whole life product. The cash builds up either at an interest rate or it could be in mutual funds. You're not invested in the company, you're invested in a separate account, so the money is truly yours. You're not a creditor of the company. And universal products offer a lot more flexibility in the design, the premium payments, and how you get cash out. So universal life, more flexible than whole life. Whole life has very strong guarantees. One other important thing just about life insurance in general is that insurance rates have actually come down over the past 10 years. So if you have a policy, an insurance policy that's more than 5 years old, you may well be able to save money by redoing the insurance. The reason for that is that newer policies are using actuarial tables from 2005 versus older policies where the actuarial tables were from 1998. And what does that mean? Well, in 1988, our life expectancy was shorter, so the insurance companies charged more for insurance. Today they expect to collect premiums longer, so the cost of insurance has actually gone down. So even if you're older, and sometimes even if your health has declined, you still may find you save money redoing your insurance from an older policy. Another thing on the insurance. Any questions on any of that? Second here. Okay. Another thought on the life insurance, and again, this goes back to how do you buy life insurance, is that, again, life insurance is all sold on commission. All insurance products are sold on commission, so there's no discounting available. You get the best pricing on life insurance by matching the carriers that best match your health and financial profile and need. So not all carriers price products the same. Not all carriers look at health risk the same. So it really is a matching process, and again, working with a good qualified broker who could represent multiple companies is the best way to do it. When you go to the internet, your name basically gets sold to a list, and people then just start calling you. If you go direct to a company, the price is the same as if you went to a broker, but it may not be the least expensive insurance available for you. So it definitely pays to shop, and that might be an area where using someone who's professional in the field and represents many companies such as a broker might be a benefit. Okay. A couple other things. Sometimes we have group policies from our previous employer that we could take and buy out. That may or may not be a good idea. The reason is group policies tend to get more expensive the older we are. So if we're under 40, group life insurance is probably very, very inexpensive. If we're over 40, it starts to get very expensive. And there's a insurance law out there called the law of adverse selection. It basically says that if you're healthy, you will leave the group to find cheaper insurance elsewhere, leaving the unhealthy people in the group, causing the rates to rise because there will be more incidents of death in that group that's remains. So group insurance is not necessarily the least expensive way to buy insurance. In some states, They do allow conversion. Some will, some won't. The best thing to do is, if you're healthy, really go out and shop what your insurance options are. Sometimes you only need it to bridge to a certain thing. Maybe you only need the bridge till you get a new job, maybe till you get the mortgage paid off. So there are less expensive ways to buy insurance. The key is you need to buy it for the right reasons and the right type from the company that best matches you. Okay? Any questions on differences between group coverage and buying it outside? I'm going to go back one slide, 2 slides. One of the other things with life insurance is, how much do I need? And there are a lot of calculators out there that could help you. Just a couple of key things to think about when you think about how much life insurance should I have. The biggest driver is income. So if something happened to me, what income needs to be replaced to keep my family whole? The objective isn't to make anyone rich, it's just to keep your family whole. So a couple of things to think about when you're coming up with that number, and there are some calculators out there that do a really nice job of this. Final expenses. It might cost upwards of $15,000 in the event of a death to bury someone. There might be some outstanding doctor bills, lawyer fees, accounting fees, that type of thing. So you want to plan that you're going to need about $15,000 just on those type of expenses. Another is the education fund. Do you have children that are looking to go to college, or maybe they're in private school and you want to continue that? How much money do you need to do this? That's probably something, if you're in that situation, you probably know very well what that amount is. Another bullet that's not on here is other debt. So how about your mortgage, car loans, existing student loans? So think about those things and add those up. There's also, then you could think about the income needed. If you paid off all those things, if your family was making $100,000 a year, do we still need $100,000 a year? Maybe if those things are all taken care of, we only need $70,000. And then how many years do I need that income? And you could do a calculation to come up with a number that helps you with that. That's something that we do all the time. So if you have any questions on that, or would like us to do a calculation for you, we'd be happy to do that at some point. Any other questions or thoughts on life insurance before we move on? Great. Another benefit that you generally lose when you lose your job is disability income insurance. So what is disability income insurance? Think of it almost as a form of health insurance. What disability income does, it provides a replacement of income due to a disability. So if you're unable to work for a period of time, disability insurance will step in and pay some portion of your income. It can also pay for rehabilitation services. A couple of things about pricing on disability insurance. One, whereas group life insurance tends to be a little more expensive in the group as we get older, disability insurance is usually less expensive in the group, especially as we get older. The other thing about the pricing is who pays for it. So if you pay for the premium on your disability policy, and some companies will offer the benefit and you pay it, you pay the premium, if you did become disabled, those benefits come to you federally tax-free, so there won't be federal income tax on those benefits. If your employer pays the premium, they are it is taxable income to you if you do go out on disability and you receive a benefit. So there are different tax implications depending on who's paying it. Sometimes it's split between the employer and the individual, and then the tax ramifications are split. One thing to keep in mind is, unfortunately, when we're unemployed, we cannot get disability coverage. So that's one reason where it might make sense at some point to get your own coverage. That way you know even when you're unemployed you have some level of disability income insurance. Again, it would be more expensive outside than in groups, and as a general rule, you cannot get disability insurance if you're not employed. So just a couple of things on that. I won't spend any more time unless someone has a specific question on it. Can we bring up long-term care? Oh, hold on. Yeah, so we have a note from Diane. My benefit was still available. I'm saying check out immediately after losing your job. Okay, that was on your, that was on the health insurance. I'm sorry. Long-term care insurance. A lot of times companies offer group long-term care insurance, and long-term care insurance is not health insurance, and it's not Medicare insurance. It's insurance that provides benefits if you're unable to do 2 of the 6 activities of daily living, and that's basically taking care of yourself, transportation, feeding, etc. Why it's a great benefit if your companies offer it is that it's fairly expensive to purchase outside, and the prices are not guaranteed pricing on long-term care insurance. So if you have a group benefit, it's really worthwhile investigating, and most long-term care group benefits are portable and really worthwhile taking with you. So, but what we found locally, we worked with a couple of companies who offered long-term care insurance, and when they laid people off, they didn't let the people know that the long-term care insurance was actually portable, and we had to go back and work with the companies to get those policies reinstated for these people. So if you had it and you didn't take it with you, you may want to consider going back to your company and seeing about getting it reinstated, because it is a portable benefit. When you're reemployed, if your company offers it, it's something that you should seriously consider. There are a couple of ways to insure for long-term care needs. You could self-insure. Long-term care stays today, at least in the Philadelphia area, are running about $6,000 to $7,000 a month, and typical stays are about 4.2 years. So you do the math. That's a fairly expensive situation and could really harm a family's financial future if the event is done and there's no way to pay for it. Medicare does not pay for long-term care. Medicare has a short-term long-term care component. It'll pay for 100 days, provided the situation is the result of a medical problem or emergency. So, just having failing health does not necessarily qualify. It usually has to be an injury, etc. Medicaid does cover it, However, to qualify for Medicaid, you pretty much, you may have heard of Medicaid spend down. Well, what that means is that you have to go through all your assets first, then you can qualify for Medicaid. So it really means that you leave your family with no other money. So, it's not the most desirable outcome. Sometimes it is our only course of action. If you're a veteran, there might be veteran benefits available. And last, there's long-term care insurance. I think here it's worthwhile noting that there are a couple of different classes of long-term care. They're the standalone traditional long-term care policies, but there's a new class of insurance that's available where you could actually buy a life insurance contract with a long-term care insurance rider that turns a life insurance contract into a pool of money available for long-term care. So say I go out and I buy $500,000 of life insurance, I can add this rider to it, and now I have a pool of $500,000 that I could use for my own long-term care expense if I need it, or leave as a death benefit for my family. So just something to keep in mind. You do have alternatives for insuring long-term care. So as we move forward, we'll start talking about some of the distribution options for your 401k or 403bs. In general, when we talk about retirement plans, you have a couple of options. One, you could leave the money where it is in your current employer's plan. You could roll the money into your new employer's plan. You could take a lump sum payment. We're going to talk about each one of these in a little bit more detail. Or you could roll the money into your own self-directed IRA. So what happens if you leave the money where it is? Nothing, really. The money will continue to grow tax-deferred. And the plans, 401k plans, do offer a little bit more creditor protection than an IRA. It's minimally more. If you looked at the hierarchy, they're right next to each other from a creditor standpoint, but they do come beyond after IRAs in the pecking order from a creditor. That might be important if you're going into some type of work where creditor protection becomes an important feature. The disadvantages are, in general, 401k plans are extremely limited in their investment options. Also, the plan determines how and how much access you have to your savings. So think about it this way. You have an IRA with the IRS rules. 401ks, 403bs, those types of things have the IRS rules and your employer and administrator rules around them. So there's another level of complexity to them. If your plan balance is below $5,000, they probably don't want you to keep it there anyhow. But the biggest disadvantage is really the limited investment options, making it really hard to build a well-balanced, diversified portfolio. So if you roll it into your new employer plan, from a tax standpoint, you haven't caused a taxable event. The money will continue to grow tax deferred. There might be some special advantage if you're holding company stock in the 401k plan that you may not get outside of a 401k. That feature has become less important as capital gains taxes have increased over the years. The big disadvantage is, again, your investment options are extremely limited, and the plan determines how much access you have to the savings. So you don't have control over it. your company and the plan sponsor really control your investment options. This third item, option 3, is to take a lump sum payment. This is one we never recommend to our clients. Taking a lump sum payment, and you need to be careful when you take any distribution from your plan that you do it in the right manner. Basically, a lump sum payment is any check payable to you. All right, so as soon as you take a check payable to you, it is subject, if you're under 59.5, it's subject to 10% penalty, and keep in mind that any amount you withdraw is fully taxable as ordinary income. The one advantage is if you need the money, you have it, but you probably lost 40 to 50% of its value by doing that pre-age 59.5. Big disadvantages are the taxes and penalties. Again, when you roll in state and local taxes, you may lose up to 50% of the value of whatever you take out. Once you take it out, you do have 60 days to roll it back into a qualified plan, an IRA. However, if you miss the 60-day window, you can never roll it back into an IRA. So if you inadvertently take a distribution, you do have 60 days to get it back into an IRA. If you miss that window, you've created a major taxable event. The other thing, with some of the new tax laws, it may trigger an additional tax, the Medicare tax, which is somewhere 2 to 3% additional. So it becomes a really expensive way to do this. The other thing, just think about this from an ordinary income standpoint. If I make $100,000 a year and I take $100,000 out of my 401k and deposit that in my bank, I've now created income for myself for that year of $200,000. That might throw me into alternate minimum tax, which is somewhere between 26 and 28%. In addition to the fees and penalties, I've really hurt myself from a tax standpoint. So you always want to be careful when considering taking a distribution from your IRA, especially if you're pre-59. The final option is really to roll it into an IRA, and these are, we call these self-directed IRAs. The reason we say that is with an IRA, you can have all the investment choices available to you. So you get to control it. You have a wide range of investment choices, whether it's stocks, bonds, mutual funds, alternative investments, etc. You'll continue to grow the money tax deferred, and and defer taxes on any potential growth. IRAs are very, very flexible from a planning standpoint. They inherit better than 401ks. They give you more options. So they work well on a number of levels. Keep in mind, IRAs do not offer loans that 401ks do, and probably should make a note here that IRAs are, 401ks, if you do have a loan out on your 401k, again, you have to have that loan paid off in a period of time. You need to check with your employer on what period of time that is. Otherwise, it will be considered a distribution. So you do want to make sure all 401k loans are paid back. While an IRA does not offer loans, there are ways to get money out of an IRA without incurring any penalties. Anytime you take money out of a qualified plan or IRA, you'll always have to pay ordinary income tax. There's no avoiding that, but there are ways to avoid the penalties. The other thing, that final one, in case of rolling over indirectly, the owner must replace 20% of the withholdings from distributions if you wish to avoid tax and penalties. I think we've already talked about that. Any questions on rolling over a 401k? Any thoughts or ideas there? All right. If you do, just put up your hand or put a note in the chat box. So other retirement plans, sometimes we have company stock. That might be in the form of stock options, might be company stock in our 401k. I think it's important before you cash the stock that you really look at your options with the stock. If it came to you as stock options, there's probably, and you're no longer with the company, they generally give you 60 to 90 days to exercise those. If you had restricted stock, in other words, stock that was offered as a form of compensation, that generally you get to take a percentage of that with you. There might be reasons to hold on to it. There may be reasons to diversify out of it. Each situation is different. There's no general rule of thumb on that. You really have to evaluate your situation, the tax implications, and the diversification implications for each of you. I do want to spend a couple of minutes on an idea called Pension Max. So just curious, does anyone have a pension due them? Pensions could come from government sources, could come from our companies, and a pension is really a promise from the company that upon a certain date, a retirement date, they're going to continue to pay us some portion of our salary for the rest of our lives. And when we think about pensions and distributions, one thing that you should consider is that there are ways to maximize it. So with a pension, you can use life insurance as a way of making the most out of it. So sometimes if for example, some pensions might offer 100% payout to the employee and a reduced payout to the employee and spouse. There's a spread there, and depending on what that spread is, sometimes you could use life insurance to cover the spread, therefore allowing you to take the higher amount, maximizing your pension. So it's a nuanced calculation, but it may be another reason if you have current life insurance and you're thinking about retiring or taking a pension, you may be able to repurpose the life insurance to make the most out of your pension. So again, it's one of these calculations that's a little nuanced, but it's a neat planning idea, and it really does help you improve cash flow in retirement if the situations are right. Okay, and it looks like, Beth, I have a very small amount of pension coming from before Verizon got rid of its 401k. Yeah, we can talk about what happens with pensions. So there are some options there where we can, you could look and see what are the best options. A lot of times companies will give you a couple different options, including a cash buyout of the pension. And again, that's a nuanced calculation where you could compare three things. Is it better to take a lump sum? Is it better to take 100%? or is it better to take a joint and survivor amount on the pension and use life insurance to protect the difference? And yeah, again, every situation is different. It's hard to make any general rules, but if you have questions on that, certainly if you're working with an advisor, talk to your advisor. You could always send me a note, and I'd be happy to go over specifics on that with any individual. So we covered a lot, a couple payout options, cash flow, COBRA, and life insurance, disability, long-term care, retirement, and pensions. Hopefully we covered what you're looking for. So there's a question on the table about annuities versus pensions. And so just as backing up for a minute, what is an annuity and what is a pension? So an annuity is a promise from an insurance company that they will pay you a stream of income in exchange for a certain amount of money. And there are many, many types of annuities, so that's a topic unto itself. But in general, it's an exchange of cash for a guaranteed payout. Your pensions are the same thing. So your pensions may or may not be giving you the best payout. A lot of times you could take the same money that if the pension is offering you a lump sum, a lot of times you'll be able to take that lump sum and go to insurance companies and actually enhance the payout from the insurance company over what the pension company would give you. There's no magic to the formulas. It's basic math. They look at interest rates and rates of return and calculate how much they're willing to give you based on what they believe they can make. From a guarantee standpoint, there are pros and cons to each. Pensions are backed by the Pension Guarantee Corporation, which offers basically 33 cents on the dollar if your pension were to default or if your company were to go bankrupt. So that's not all that attractive from a security standpoint. Insurance companies in many respects have stronger guarantees based on their rating of the company. Insurance companies are held to cash reserves. Insurance companies many times reinsure, and then in addition there are state benefits, state guarantees on insurance-backed annuities. So yeah, a lot of times they may be the best alternative. Again, you got to look at each situation and each pension individually. There's no general rule of thumb, but it's something worth looking at and evaluating in each individual situation. I hope that that helped with that question. Before we wrap up, any additional questions, comments, concerns that we haven't addressed? Show of hands, it looks like don't see any hands. So as far as next steps, it really is important to that you do have a plan, whether it's for your career or for your finances. Having a plan is really important. And the planning really starts with understanding your risks and your opportunities out there. From a financial standpoint, risks are certainly related to health and your life. From a financial standpoint, your ability to earn income is really important and probably your biggest asset. So protecting your ability to earn income is really key. When you think about finances, think in terms of timelines. What's going to happen, how much money do I need this year, next year, and then beyond. Consider time buckets of money, 1 to 3 years, 3 to 5, and then 5 and beyond. We'll be happy to answer any questions. You can contact me at my number there or my email address if you want to drop me a note. John Mayer is an associate that works with me. He is a CPA and part of my team, so we'll be happy to address any questions you have. It's been a pleasure,